Good morning. Late last year, 2023, our investment banks and energy agencies released their estimates for oil demand and prices for 2024. These estimates are important because they inform CapEx and oil field production schedules by energy companies. Barclays is a London bank that finances a lot of Europe's energy trade, and Barclays forecast Brent crude to average $93 per barrel for 2024. Most of the estimates came in line with theirs. The EIA's forecast was also for $93. Bank of America predicted an average of $90, and Goldman Sachs' number was $94 per barrel. We're almost through the third quarter for 2024, and here is what happened to the oil prices. Brent crude. Brent is the price index for Europe, for the oil that comes from the North Sea production. And let's zoom in to get a better view of 2024. In mid-April, Brent pricing rose to the low 90s dollar per barrel, then dropped back into the 70s. Now it's at $71 a barrel. Barclays, Goldman Sachs, and the EIA said that Brent crude would average $93 to $94 a barrel for 2024. Thousands of their customers in the energy sector built production schedules and they made investments based on those numbers, and they didn't happen. There are two aspects to the situation that faces oil producers today. There is a real demand-side destruction underway, led by China's electrification of transportation and affordable clean energy technology that they're exporting to the developing world, which was supposed to be a huge new market for oil companies as these countries developed. But this is the second feature, which is that the BRICS countries and the developing world are also shifting where they prefer to buy their oil from. There is still a lot of oil demand, but it's moving away from our suppliers. And as those markets move outside our suppliers and away from our banks and our energy traders, we don't see markets anymore. This is JP Morgan on Rigzone, which is an oil industry paper, and they're explaining that their company also got everything wrong on the oil demand side. This is from last week, 20 September. Global oil demand is 600,000 barrels per day below what they had estimated thus far for the third quarter. And year to date, JP Morgan is off by 400,000 barrels per day. These are big misses in estimates. And to consumers, the fact that oil prices are much lower than anyone thought, that's good news. But it's also weird when we think about it, because everything we buy in North America and in Europe, inflation is driving up prices. But oil is down, which is good news for consumers at least, but for producers it's a different story. Most major U.S. oil field projects, for example, are profitable at over $90 a barrel, but they start to lose money at $70 or below. This is a chart of oil price break-evens required for oil projects across the United States. The blue line is where WTI crude needs to be for wells in these formations to be profitable. WTI is West Texas Intermediate, which is the U.S. oil price benchmark. WTI's closing price yesterday was $67. So 67 is the current price. And in the Permian Basin, oil producers need at least $70 a barrel on the WTI before they start to make money on new wells across the entire U.S. oil field sector. These break-evens are too high to justify new oil field investments anywhere, so they're scaling back instead. Rigzone updates the active rig counts in the U.S., and our energy companies are cutting the number of active rigs in the U.S., dropping for 5 out of the past 6 weeks. And this follows a 20% reduction in rigs from last year. So new CapEx is going away, rig counts are dropping, and companies will be laying off because everyone was hoping for oil prices to be in the 90s, but the prices kept falling. A good question then is why our experts got everything so wrong? How did they miss all the demand and give such bad guidance about where oil prices would be? And the answer is that they were largely right about global demand, but they were wrong about who was going to meet that demand. The BRICS countries and the OPEC plus group of countries have built a parallel economy for the energy trade. They now bypass Western banks and Western energy companies. And this trading system is growing while ours is shrinking. They no longer need our oil companies, and they certainly don't need our banks. China is importing record levels of crude oil from Iran, for example. In August, last month, China imported 1.75 million barrels per day, which is 50% higher month on month and an all-time record. On this chart from Bloomberg are Chinese imports of Iranian oil in millions of barrels per day. From a low of about 200,000 barrels per day in early 2020, they're now doing 8 times as much. JP Morgan was struggling to explain their forecasts that were off by 600,000 barrels per day. And here it is. It's at Rigzone, which is about 50 miles that way, or in Dalian, 100 miles north. Bloomberg has it right, and that makes them an outlier. Here's an interview with an expert on NPR, and she's asked why oil prices are dropping. And she says that demand from China is lower than people thought, which is true in one way. China's demand for oil from Western companies is way down because they're doing business with Iran and Russia and other BRICS countries instead. This is Barrons trying to get a better handle on things. BP is a former British Petroleum. They're saying that global oil demand is going to peak next year, level off, and trend lower forever. OPEC, though, believes differently. Oil demand is rising, and there's no end to it. They forecast oil demand will rise for another 20 years. Barrons is wondering how BP, which is a giant energy producer, and OPEC, giant energy producing countries, can have such divergent views on global oil demand. But they're both right. For BP, demand is going to fall. For OPEC and Russia, demand is going to rise because they're taking sales from BP and the other Western oil majors. For our producers, global markets are going away. What's more, we don't even know what the global markets even are. Here's Barrons again. Forecasters don't even agree on present demand. OPEC says first quarter demand was 103.5 million BPD. EIA says it was 101.7. The variance in the numbers is becoming so wide that it's leaving investors with a lack of solid information. We need to get used to this because so much of world trade is now conducted outside the US and European banking systems. We don't know the markets anymore. Our industry executives and our investment banks, we don't know the basics, the demand, how the demand is being met, and what prices are being paid. We can only see falling prices in our own markets, and we simply must conclude that the demand is being met. The economic sanctions against Venezuela and Iran and others simply incentivized oil producers to figure out ways around them. And then when we put similar sanctions on Russia and then compounded it by seizing their reserves held in European banks, that put all these efforts on hyperdrive. Suddenly, companies and governments across the world were racing to build and then join an alternative system of payments and trade so none of that could ever happen to them. And as they did so, we can't see what they're doing anymore. Here is the Atlantic Council. They explain how China and Iran figured out long ago to get around Western banks and transport systems. Now Russia is playing along too, using the Chinese currency, the renminbi, to conduct trade. It involves fleets of ships, small refiners and trading companies in China. They also use small banks who are already under sanction by the West, so now those banks have nothing to lose by doing trades. Once the oil gets to China, it is retitled to say it's from Malaysia or the Middle East, and then it can be used here in China or resold to other markets across Asia. The use of the Chinese currency and payment systems restricts Western access to financial transactions data. This also undermines sanctions enforcement. Yes, that is the point. Our sanctions say they're not allowed to do the trade at all, and they can't use our banks. So they set up their own banks, and now we can't see what they're doing. We should not be surprised that China, Iran, and Russia figured out how to trade oil without the help of JP Morgan or Barclays. And we shouldn't be surprised that when they figured out how to do that trade, they now prefer to do it among themselves instead of with us. Now all we see on our side are falling prices when we thought they should be going up. Our companies see collapsing demand on our own order books. while their companies see big jumps in demand and they're building out to meet that demand. Our producers and investors and even our investment banks are losing money, while the OPEC producers are doing better than ever. And the BRICS countries are getting better prices. This is Chengdu, Sichuan province. Be good.
Yes, global revival in this part of the world. That your children, that your church are empowered to go and make disciples of this nation and all nations. Thank you for sending your Son, Jesus, to die for us.